Hi, everyone. Welcome to our mid year market update. As Darren mentioned in his latest video, he did manage to clip one of his wings, but thankfully, I'm happy to report he's recovering well. In light of that, though, I will be the sole captain on our journey here today as we look back on the quarter that has happened and what is ahead. Before we do that, though, as is customary for these presentations, a quick word from our lawyers and moving along. In what's been one of the sharpest 3-month rallies in the history of the S&P 500, we've once again been vindicated for our messaging earlier this year, which is to stay invested and stay diversified. And we thank our many clients for heeding that advice and trusting in us to manage around those periods of extreme volatility. This quarter, the resurgence in growth appetite was exemplified by the strong rebound in the AI and Mag 7 trade, led by technology and communication services performance. Industrials, one of the areas that we highlighted coming into the year, also continued to perform well. Notable laggards this past quarter included defensives such as staples, utilities, and healthcare. And as a brief comment on healthcare, we do continue to like areas of the healthcare sector, which is now trading at an all-time low relative valuation to its own history as well as to the S&P 500. And anecdotally, earnings season has started well for many of the entities within our coverage. Underpinning this rapid rise in equities over the last 3 months has been a re-expansion of valuations up to recent historical highs, which we did flag as an area of caution coming into the year. This again speaks to the need to remain active and selective in this environment. Earnings growth, though, has remained supportive, with the bulk of companies that have reported in the quarter to date having beat estimates. And while the Mag 7 trade has certainly worked with market concentration now back at historical peaks, that bout of volatility into April reminded us again of the importance of remaining prudently diversified. As a quick reminder, the Mag 7 constituents sold off much greater than the overall market during that period. Now, we do have exposure to the Mag 7 across our portfolios, but that exposure is equally complemented by allocations to strong businesses in several other areas of the economy or even adjacent to the Mag 7, as we identify through our bottom up research. And when we last spoke, we also highlighted a key asset allocation that arose early in the first quarter, which being our long term view of European markets. However, when we spoke then, we also spoke to a still fragmented near-term economic picture, exacerbated by the tariff-related sensitivity of European markets. This led us to retain exposure to US equities while also beginning to allocate more fully to Europe. That tactical decision was so far the right call, with US markets having outpaced European markets since the end of day lows around April 8th. However, in US dollar terms, US markets have certainly gained ground as a result of early year equity market multiple re rating and the continued depreciation of the US dollar, especially against the euro. And if you haven't had a chance to watch our last quarterly video, we did highlight some of the reasons then for that flight of capital. On to tariffs, the never ending source of news for the likes of CNN and CNBC. We've certainly seen tariff pressures subside from the peak uncertainty in early April, and that too has dragged along the aforementioned boomerang in equity markets. However, I remain skeptical that this story is done and dusted. Tariffs will likely settle at the highest level since the 1930s, around or above 15% once country specific and sector specific tariffs via the 232 investigations finally conclude. 15-20% seems to be the new 10%, as evidenced by the recent agreements with Japan, the Philippines, and the rumored agreements with the EU. And as a brief touch point on tariffs, outside of critical industries, we still remain skeptical that tariffs are going to lead to a mass reshoring and fix the decade-long decline in manufacturing in the US, especially given global labor cost differentials. Likewise, while China and the US have reached a temporary compromise from the elevated levels in April, they too remain at odds on critical issues of national security. Anecdotally, based on the chart on the right here, we've also seen some of that tariff front running, which is the excess or increased import of goods in advance of tariff enactment, now subside. And this could weigh on manufacturing activity and output in the months ahead. Now, I found this particular chart as part of the countless research articles that we peruse in terms of our daily reading and decision making, and thought it would be a great representation of President Trump's negotiating tactic while also adding a bit of levity to the conversation. As a precursor, there is always a deal. So if we just start quickly on the side of the left of this page, and I would implore you to pause and read it at your discretion. But if we start on the left and we start at start one, it's to ask for the moon, such as open your entire economy to the US and receive nothing in return. When that outlandish ask is not met with the excitement that you anticipated, you move to step two, which is whip out your big button, or in this case, threaten, such as threaten Canada with statehood. Step three is when no one is quite believing your threats, actually go ahead with it and punch someone in the mouth, such as Liberation Day, when Trump actually enacted tariffs at much higher levels than anyone would have anticipated. When you've done that and market uncertainty is at its peak, you break bread and make friends, or in the case of the Trump administration, enact a negotiation period for tariffs and reduce the effective rate that you stated on the onset. When those negotiations aren't quite going as well as you may have hoped, re up the pressure, leave the bride at the altar. And in this case, set a new deadline, such as August 1st, where tariffs boomerang back to the level that they were at on Liberation Day. When that scares your counterparties once again and creates some leverage, you kiss and make up, you renegotiate, and ultimately you move to step seven, which is to make a deal. And you, of course, proclaim that as the best deal ever made. Even in all likelihood, it may not be the case. So right now we're firmly in the 4 to 7 steps of this 1 to 7 step process. And, as much as we expect a deal to be made as the ultimate outcome, that doesn't mean it's doing any good to overall economic uncertainty. We can see here that trade policy uncertainty has now contributed to the highest levels of economic uncertainty over the last few decades. This has led to some aversion to US denominated assets and, as we would expect, downward revisions to global growth as tariffs impact the free flow of goods and companies remain in a standstill with respect to corporate planning decisions such as hiring and capex investments. So while yes, we do expect deals to continue to be made and certainly settle at much lower levels than Liberation Day, as we outlined in the last two slides, tariffs are going to contribute to continued uncertainty and are likely to settle at much higher levels than any time in the recent past. What is also becoming clear from company commentary and inflation data is that consumers will bear the brunt of tariffs, regardless of the Trump administration what might want you to believe. The supply chain typically constitutes a foreign producer, a domestic importer, a wholesaler and front end retailer, and then ultimately the end consumer. Goldman recently published a comprehensive study that estimated that 70% of tariffs will be borne by that end consumer. So while service inflation continues to trend down, and we expect continued disinflation based on leading labor cost indicators, goods side inflation is now reinflating. We can see this most predominantly on the chart here on the right, and through detailed inflation data, which shows consumer goods areas such as video and audio equipment, clothing and footwear, toys, sporting goods, and furniture, all being subject to recent price increases as the result of tariffs. Certainly, this has fed through to monetary policy decision making, as one of the prongs of the Federal Reserve's dual mandate is price stability, i.e., inflation at or around its long run goal of 2%. Now, let's talk about that other prong, maximum employment. The labor market has so far remained resilient, and layoffs have only trended up slightly, while openings and quit rates have come down but remain at or below prior COVID levels. The latest job report was robust in terms of overall job growth. However, there are still some signs of slowing beneath the surface. For one, most of the jobs produced in that latest report were state and local government, which are frequent to seasonal adjustments. Private sector employment, the lion's share of overall employment, is indicated as continuing to trend down from advanced indicators of private sector labor demand, such as Indeed and other surveys. We can see that most notably here on the chart on the right. And so this is an area that we are most concerned with watching over the coming months and quarters to ensure that private payrolls do not decelerate from their current stall speed. And before we get to interest rates, there's another economic development that we must touch on. The One Big Beautiful Bill, designed as an extension of the 2017 Tax Cuts and Jobs Act, also makes permanent key favorable business provisions, including the reinstatement of bonus depreciation, which is significantly accelerating the amount of amortization a business can take for the year an asset that goes into service. Ultimately, this helps reduce the end tax liability for a corporation. The bill also includes reforms to clean energy incentives, while also increasing funding for the likes of border security and defense. However, this bill doesn't come without a cost. Next year alone, the One Big Beautiful Bill is expected to add more than 400 billion to the deficit, or about 1.3% of GDP. Of this amount, the funds allocated to extending the tax cuts introduced during Donald Trump's first term will not have a stimulating effect in our view, as they'll only serve to retain the status quo, and that's about 50 basis points. Of the remaining 80 basis points in potential fiscal thrust, that may not fully materialize. The first reason is that the main beneficiaries of the measures contained in the One Big Beautiful Bill are individuals with a generally lower propensity to spend, i.e., those in the middle income quintiles. These groups are likely to save some of the money provided to them by the bill instead of rejecting it into the economy. There is some near term stimulus to higher income households, but they've already driven the bulk of consumption in recent quarters as lower income household spending has weakened considerably. The second reason why the One Big Beautiful Bill may prove less stimulative than headline figures might suggest is that the bill is going to be implemented at a time where the US economy is running at or near capacity. And so the fiscal impetus from the bill may result in a rise in inflation or overheating, which would thereby reduce real GDP. So, yes, there are certainly positive provisions, particularly when it comes to business investment and the extension of those tax cuts. However, we remain skeptical as to the extent of new growth that the bill will ultimately fuel. And briefly on that aforementioned fiscal trajectory, we can clearly see, as we expected coming into the year, that even with tariffs, the forecast for federal deficits and net debt continue to rise significantly. Eventually, this will read some reconciliation or bond market intervention by the way of higher yields. So, with the two prongs that we've just discussed, our stance really has not changed. If and only if the labor market weakens considerably, do we believe that the Federal Reserve will be forced into cutting quickly. Otherwise, we believe they, being the 12 voting members, will be content to wait and observe the potential inflationary impacts from tariffs. And as much as Mr. Trump can call for Chair Powell to be fired or rates slash 300 basis points overnight, the market has given us a clear taste as to the pushback that will follow. Plus, as I just indicated, the majority of voting members there being the key word as it's not an autocracy, continue to favor a more hawkish stance. So attempting to replace Chair Powell before his term ends in 2026, which Trump frankly does not have the authority to do and would face a bevy of legal hurdles, is frankly irresponsible and erodes trust in US markets. The Fed should and hopefully will remain independent, and the recent scaling back of harsh commentary suggests that the more pragmatic members of Trump's inner circle are finally listening. Turning now to Canada, private sector employment grew more strongly than forecast in latest reports, while public sector employment rebounded from a drop following the May election. However, employment surveys remain quite weak by historical standards, and despite the marginal tick up, we continue to see weakening in private sector labor demand in Canada. This is likely to put continued upward pressure on the employment rate in the months ahead. And on the inflation front, it's a very similar picture to that of the US. Declines in population growth should aid rent inflation, alongside recent rate cuts, which will flow through to a normalization in shelter inflation. Likewise, a slower labor market, which feeds through to labor cost, indicates that services inflation should remain on its disinflationary path. However, Canada does still have counter tariffs of 25% on place on select non-USMCA compliant goods. These include auto imports, steel and aluminum products, and US consumer goods such as sports equipment, computers, and tools. And we witnessed in core goods inflation in the US, we're now seeing in Canada, as we're now seeing more pressure on Canadian goods side inflation from those retaliatory tariffs. On the GDP front, the growth picture frankly remains quite tepid, with business barometers and surveys having rebounded from the peak of Canadian US tensions in April and March, but remaining well below positive territory. Likewise, new export orders in Canada still point to a sharp fall in non energy exports over the coming months. What does this all mean? Well, with a still weak labor picture and relatively meager growth, we still expect the Bank of Canada to cut rates twice before year end to support the economy, though elevated price pressures through tariffs are certainly a risk to this forecast. The boost to the loonie from investors' retreat from the US dollar has stabilized and is now broadly in line with Canada US rate differentials and has traded within a set range of around 136 to 138 USD over CAD over the last while, as we expected in our last presentation. We would now forecast it to continue to trade fairly tight range over coming months. Now, as a final note on Canada, let's talk about Carney's first few months in charge. I'll preface this by saying it's not our job to be political zealots. We instead observe and make decisions on facts and policy. And certainly, there's no monopoly on good policy. The Prime Minister seems determined to make Canada a more business-friendly country by upgrading the natural resources sector, simplifying regulations, and reviewing military procurement processes. In this way, we could perhaps see business investment finally emerge from the decades-long slump that we've been in. In the interim, we do find some assurance in the government's efforts to quote-unquote make Canada investable again. On July 9th, Mr. Carney announced a cross-departmental review of all federal regulations over the next 2 months, aiming to reduce red tape and help revive some business investment. A rise in defense spending, frankly, is long overdue, as we can see on the chart on the right. For years, Canada has lagged most other advanced economies in the share of output it's devoted to its military. In 2024, it ranked 28th out of 32 NATO countries by this measure. Around half of the additional spending will be committed to reassessing this procurement process in order to help boost Canada's self-sufficiency and reduce its ultimate reliance on US as a critical trade partner. However, this will take years to correct course, but could ultimately set the economy on a higher growth path further ahead if the government retains its firm commitments to spending at or above 2% of GDP for the foreseeable future. And lastly, as a closure to our comments here on Canada and the environment that we're in, I wanted to just briefly touch again upon Canadian-US tariffs and our relationship with the US. Ultimately, we still continue to expect a relatively more favorable outcome as both countries work to a new USMCA framework. This may entail some level of base tariffs, but we do not expect it to be at the level of other nations. So with that, I just wanted to say thank you for joining me here today as we went through our mid-year market update. We look forward to speaking with you again over the coming months and encourage you to reach out with any questions. Please do enjoy the rest of your summer. Thank you.